Welcome everybody to the 2025 Kickoff webinar here for Balance. We're excited to have Nic Gookin, our Chief Investment Officer, to be here to start with a little bit of review of 2024 and what we saw over the last year, which was a really fun and interesting year, as many of us know from an investment standpoint, but also then shift gears a little bit and just look forward into 2025. Obviously, a lot of things happening in the world here domestically with the new president just taking office on Monday. So we're going to do our best to kind of cover those two pieces and just how that fits into our strategies here at Balance, how it may impact your portfolios, your plan. But as we go through this, please remember that we're always here to ask or answer any additional questions, anything that you might want, how it ties in with your financial plan, because as important as the market is, as these investments are, it's more important to make sure that we're sticking to each of our clients' specific plans. And so everybody's investment strategy is going to be different, but hopefully this gives some really nice, helpful insights and some guidance in our decision-making process. So again, really excited to have Nic Gookin here. He's got a great presentation together, a lot of fun charts and graphs. I'm going to go ahead and put it over to him. But again, I'll say that if you have questions, please put them into the chat at any time. If it makes sense, we'll interrupt Nic and say, hey, Nic, we've got this question. And if it makes sense, we'll wait till the end because we're going to give Nic about, 25, 30 minutes. I'll let him talk as long as he needs to or feels like it. But then we want to have plenty of time to answer your questions as well.
Perfect. All right. Well, first of all, thank you all for tuning in tonight. I know there's a lot of other things that you could be doing on your Thursday evening. And for any of y'all that I haven't met yet or had a one-on-one conversation with, I do look forward to getting to talk to each of you one by one and answering any of those questions kind of one at a time. But today is the day of charts and graphs and investing. So if you are a numbers nerd, this will be awesome for you. And if you're not, I will still do what I can to make it as enjoyable as possible for you too. So as Bob said, we're going to take a look at 2025 forward looking, but the first half of the presentation is actually looking at 24 in review. So I figured let's just start with the slide with the most numbers on it to get us warmed up here. So this chart or this graph chart slide is showing all of the different S&P 500. So it's kind of a barometer for the U.S. stock market. It's a basket of the 500 largest stocks in the U.S. And over the last 100 years. And so each of these numbers is showing the calendar year and then the return of the stocks. And so the average return is actually about 10%, which falls in this middle category in the pink. But as you can see, it's almost never just an average year. It's usually plus 20, plus 30, minus 10. And so the market tends to zig and zag all over the place. But at least according to this chart, and I think by all of our standards, we can safely say that 2024 was a great year where U.S. stocks finished positive 25% on the year. So we will celebrate the successes as they come. And I am very humbled and thankful to be your investment guy in the year when stocks have been absolutely ripping and rolling. So anyway, this again just helps from a financial planning perspective. We might say hey, we're shooting for an average 6 or 7 or 10%, but just know how we get that average is from a very wide dispersion of returns. So all right, and Tyler and all recommended this chart and I couldn't say no. So this is a good one. So 2023, the stock market was up 26% and 2024 is up 25%. So yeah, back-to-back years of massive double-digit returns. And so then the question is well, what's happened when that's happened before? And really not a lot that we can gather from just basing our decisions on that. So half the time that this has happened before, the third year was negative, and the other half the time that it happened, that third year was positive as well. So we do expect that 2025 will be positive too. I'm not sure 20+% is the right like magnitude or assumption. Most analysts are estimating a roughly 10% return, average return for 2025, but we'll see, and we'll get into this a little bit deeper here too. So, all right. So again, that average return has been 10% for U.S. stocks, right? But that again was not just a linear experience, and all of you guys on the call know that very, very well and intimately that it's just not an average, steady, stable, linear return all the time. So this chart, again, showing S&P 500 returns, but also what the intra-year drawdown has been for all of these returns. So those red dots are showing what the worst case scenario was throughout that year. And even in the last 2 years, where we had great years in stocks, the max drawdown was 10% and 8%. So through the course of that volatility there, we still had times that were stressful for folks, right? And if you were just watching the news and you clicked and said, oh, market's down 8% or 10%, like that might, put you not at ease, so to speak. So this is more of a conversation to keep you all invested for the long run, and just know that if you filter out the noise of the drawdowns, there's good fruits ahead. So, all right, I'm gonna keep blazing along here. I got a lot of slides to get through, so sorry if I'm talking a little fast, but you'll appreciate it if I get through it all. So again, this is kind of just honing in more granularly on the different areas of the market over 2024. So the blue line is what we've been talking about, which is the S&P 500, again, up 25%. But there's more to the story than just U.S. large cap stocks. And most of our clients, all of our clients, are diversified, where we don't just own U.S. large cap stocks, we own some other things. And so the orange line is a great example of one that's been very volatile, and it's small cap stocks, and it was super volatile, had its best run ever in the history of small cap stocks in July. And when I say small cap, it means like they're still massive companies by any standard. They're just smaller than the 500 biggest ones. So slightly smaller companies, this might be a better way to describe them. But again, they had a double-digit return, not bad in any normal year, but compared to the blue line, it's like, oh man, I wish I was in 100% the blue the whole time here. And same with the purple line. So purple being international stocks, or stocks whose companies are headquartered outside of the US. For most of the year, and even through October, they were up 15% on the year, if you see that. So they were having a pretty good year, but as the Trump victory came into fruition, they sold off there through that last quarter. And so they ended the year plus 5%, not super exciting. But again, that's part of the geopolitical shifts that we're going to be talking about here in a little bit. So, and then lastly, which I know probably most people tend to care about, even though it's the least fun or least sexy line on here, is the aggregate bond index. And that's kind of the safe money assets. And again, it's kind of a similar story to international, but all the way through September, bonds were up over 5% on the year. And then in September is when the Fed started cutting interest rates, and counterintuitive as it is, bonds, the drawdown came down about 4% over the next few months there. So we'll dive plenty deeper on bonds here in a little bit too. But again, just kind of showing the different pieces in a graph, and also showing how, again, that 25% return was not just a straight line. Like there was still plenty of zigs and zags and drawdowns through this whole experience here. So, all right, I don't see any questions coming in yet, so I'm gonna keep rolling with it. All right, so getting more granular to all of the, numbers nerds that I promised I would talk about this stuff. So let's start with the donut chart in the middle of the screen. So of the days in the market, 58% of them were up days and 42% of them were down days. And so at any given point, if you tuned into the news and there's a 42% chance that you're looking at something saying the markets are going down. And so that by itself plays a really big piece into psychology. And I'm not saying that you shouldn't watch the news or be well informed. I encourage you to be well informed. But they really tried to exacerbate those down days into something more than they're not, because this is a year where markets are up 25%. And again, it's not because every single day was positive. It's because, we happen to have many more up days than down days, and the magnitude of the up days were much better overall. So just a quick touch on the sectors, because that's always fun to talk about. So it was about 4 or 5 years ago, they actually reclassified some of the tech sectors, which makes it a little bit fuzzy when I say technology, like communication services. Like, what is that? And that's kind of a messy way to look at tech. It includes companies like Verizon or like telecom, but in reality, it also includes like Google and Facebook. And so it's kind of a hodgepodge category, but in general, technology and communication stocks up 30% on the year. It's incredible. It's a great year. And then the biggest laggards would be materials, healthcare, and real estate. So again, most of those are still positive, right? 2 or 5% wouldn't be too bad on an average year, but compared to 25% in the market as a whole, or when there's other sectors rallying 40%, it's pretty big dispersion there. So healthcare, I'll just touch on that one specifically. That whole sector is kind of out of favor right now and has been through 24, because they are expecting massive amounts of changes in regulations, and it's also very much under fire for the way they advertise and collect revenue from that. And just the whole Trump and RFK administration is expected to be very disruptive to the healthcare sector as a whole. So just from the uncertainty factor alone has been the reason that folks have kind of stepped away from that particular bucket. So, okay. There's a lot. We'll keep rolling here. I don't know. This might be the chart with the most numbers. I should have figured that out ahead of time. But this chart's called the carpet chart or quilt chart, or one of those things. And if you haven't seen it before, it's just a great visual way to see a lot of different asset classes or areas of the stock market and bond market that you can invest in, and how they performed for different calendar years and relative to each other. So again, we see US large cap stocks up at the top these last 2 years. But the asset allocation portfolio, which is a blend of these things in a 60-40 allocation, was the third best performer of all these different pieces, but it was only up 10% over that time period. Now, our clients, for the most part, have been really overweight US over the last calendar year. So the 60-40 portfolio, I think across the board, we did much better than this 10% chart that JP Morgan's showing here. But just to kind of level set the expectations on this, the point of the 60-40 is, we're not making a big bet, or we're not putting all our eggs in one basket, right? We're diversifying, and the whole point of that is to smooth out the ride. And you see that's why the asset allocation portfolio generally tracks down the middle of all of these different moving pieces here. So again, 2024 in line with expectations overall. Okay. All right. So in this one, again, just more granularly looking at stocks and bonds specifically. So within the US, in the S&P 500, you can actually kind of break it down into 2 categories: growth stocks and value stocks. So growth stocks are companies where when they have profit at the end of the year, they take that profit and then just reinvest it back into the company to increase its capacity for growth. Like if it's a manufacturing company, maybe it'll build more factories or plants, gadgets, gizmos, all of that good stuff. Like Amazon, Tesla, Apple are generally considered like growth stocks, whereas value stocks are companies that are typically a little bit further along the life cycle and they don't have a lot of ways to grow, so to speak. And so instead of reinvesting that money back into the company, they typically will distribute it in the form of dividends. So over the last year in particular, and this has been a phenomenon happening for the last 20 years, but growth stocks have significantly been outperforming value stocks. And so this is like when I get a lot of questions like, hey, I really like this dividend strategy. It's like, I don't disagree with that necessarily, but you just have to look at it through the lens of total return, because ultimately that's what y'all care about. That's what we care about, is the total return in your account. So again, we're not taking huge bets on any single one of these things necessarily, but it's just helpful to know how all the different pieces performed over the calendar year. And bonds, we touched on it lightly, but they have been, again, rough end to 2024, still positive for the year, but really it's because the long duration, if you look at the kind of outlier here, long-term treasuries down about 8% on the calendar year because long-term interest rates were higher for longer. So we'll get into that here. All right, we'll keep blazing on here. So because Bob told me 25 minutes, and I can definitely do that if I talk fast. So this one is pivoting from stocks and just talking about bonds for a second. It's kind of that same like performance per year, and then what was the max drawdown in that year. So even bonds, which have been kind of known as the safe haven asset, they still experience drawdowns intra-year, right? It's not always positive all the time, but on average, they have returned about 6.5%. And historically, over the last 40, 50 years or so, they had positive calendar years 97% of the time. So it really just goes to show what an anomaly 2022 was, and how painful that was. I know for all of us who are invested in fixed income through that period, but also just showing, like we do expect the returns to kind of normalize up from the 1%, or else we certainly wouldn't continue to allocate to that. Okay. All right. So folks that tune into the news, some of the headline names or phrases and just industry jargon that you might have heard is called like the Magnificent Seven or the Mag Seven. And it's kind of, I don't know, I have mixed feelings about even referencing that because and showing charts like this, because back in 2020 and 2021, no one was calling it the Mag 7. They were calling it the FANG stocks or the FANG Plus stocks at one point. And so they kind of like changed the companies that are in these buckets, and they pick the ones that happen to be the best performers of these time periods. So don't beat yourself up if you missed the Mag 7 in 2020, because nobody was calling it that in that moment. But it's helpful to see, just if we look at the S&P 500, so those 500 biggest stocks, and we just strip out the top 7, the Magnificent 7, that's this green line on the left and how it performed over 2024 versus the S&P 500, which is the gray, versus the blue line, which is the S&P 493. And so you can see like most of this return in the stock market has actually been driven from these Magnificent 7 stocks. And a lot of people and concerns that I hear is like, oh, the market's too concentrated. It's these stocks or nothing. And even though that's largely been true, the reason for that is they truly do have the best earnings out of anywhere in the market. Like their profit margins are 20+%, and their earnings and earnings growth are insane relative to the rest of the market. I mean, they're like compounding at 10-20% a year on their earnings. So the money's there, the cash flow's there. So these are actually considered high quality companies because there's so much cash flow there. And like, yes, the expectations are high for them to continue growing at these rates and continue making these cash flows. But the performance has been well merited up until this point here. So
And Nick, if I can interrupt just very quickly, just to throw a thought from me out there. This,
Mm.
in my mind, is less of a reason to try to find the next Magnificent Seven and more of a reason to maintain diversification because we're looking back and
Mm.
cherry picking the best seven stocks and saying, oh my goodness, look if you just invested in these seven over the last whatever time period. When in reality, if we maintain a good diversified approach and don't try to make these huge, heavy bets, we're going to participate materially in the ones that naturally kind of the cream rises to the top sort of thing. So, I think that we hear a lot about the Magnificent Seven in this concentration, and people are like, well, why didn't we just put everything in that? It's because we can't really ever know what those are going to be. And I love the reference to the FANG stocks that we
Mm.
used to talk about, 4, 5, 7 years ago, which are part of the Magnificent Seven in some way, shape, or form. But I think this does less to say, hey, we should bet on stocks and more to say we should maintain diversification. That's just my 2 cents.
Yep, absolutely. Absolutely right. So, yeah, couldn't agree more with that. Like if you were making big bets, there was, you know, seven were in this bucket and you had a 7 out of 493. So whatever percent chance that is that you're trending more toward this blue line if you picked stocks, right? Like statistically speaking, than the green line in this case here. So, I don't know if somebody just asked a question here. Q&A. All right. All right. So what are our main sources for gauging geopolitical environment to determine if investment strategy needs to be altered? Well, I'm glad you asked because we didn't get into geopolitics at all yet, but we will get there here in a minute, Bruce. So I'm going to pause on that one and not answer it yet. See if my slides can answer that for you. All right. So we just talked about stocks and bonds specifically, and I'm going to kind of pause on that and talk about the economy, which like there's always this kind of misnomer that the stock market is the economy, and there are two things that are always the same. And the stock market is generally a leading indicator of the economy because information gets processed and digested in real time and then often gets reflected in different areas of the market and stock prices. But the underlying economy is still very important, and it's a little tough because most of the economic indicators today are still very lagged. Like the data that we get is 3, 6 months, or even a year lagged in some cases. So the stock market oftentimes is a good reflection of the economy, but it's not always one-to-one, and they don't always zig and zag at the same time, the way that you would expect. So as we look at the economy as a whole, unemployment rate is sitting like right in this sweet spot right now. The level of concern, according to this chart, 4.1, we're sitting just over the level of concern. And that's why we see so many moves in the stock market when these employment numbers get released. And everyone's like, oh, it's, it's way better than expected. Like more jobs were created. And so, and then 3 months later, it's like, oh, never mind, we were off by 40%. And so that was actually a negative. So the last 3 to 6 months have been really volatile on these numbers, but currently best estimates say we're doing okay from an employment perspective, which is generally a huge recession indicator if you see a big spike in unemployment. Industrial production. This one is like interesting because the U.S. economy is very much a service-based economy now, but the industrial production is still important. And over the last year, it's been really lagging. It's actually decreased its production capabilities. But everything I've read and seen, and with the Trump administration to bring back manufacturing to the U.S., I can't imagine that this number trends downward more. But again, lofty expectation here. We want this number to be over 5% to say the economy is growing and healthy and trending in the right direction from that perspective. So small business optimism. We talked about small cap stocks. These are like absolutely like even smaller businesses that get reflected in this survey, like the deli shop down the street and that kind of thing. But small business optimism is actually, I don't think, ever been higher, and I have a chart to show you that. But people are very optimistic about the future, which is generally good because it means they'll spend more, or they'll take more risks to maybe hire that extra person because they're planning on growth. And so optimism and small business forecast, which is the backbone of the American economy, we want to see that healthy and strong. And then personal income. So right now, economically, even though inflation's been really tough and even though interest rates have been high, if we look at the country as a whole on average and all that, like we are still collectively saving money in year over year, where we have more income coming in than going to debt servicing and all that. So we'll dive into there. All right. Hope y'all are hanging with me here. So getting a little bit more into the consumer side of things, because again, our economy and so much of the GDP and just the economy as a whole is really based on consumers and consumer spending. So to the extent that consumers are in a good spot is generally a good sign for the economy, and the extent that they're in a bad spot, then we know right away that we're going to have some rocky times ahead. So these numbers are just kind of mind-boggling and staggering, but the total assets estimate of the U.S. consumer in America is almost $200 trillion of assets on our balance sheets. And to put that in perspective, the national debt that we're all hear about all the time is about 36 trillion, I think, right now. So even though that number seems ridiculous and huge and high, that's nothing compared to 200 trillion in assets. So that was kind of interesting there. But then also just looking at the total assets versus our total liabilities on a consumer basis, we're in a very good spot overall. And even, like student loans and auto loans and all of these kind of more sensitive areas of the debt market really don't represent a huge portion of risk relative to our assets, so to speak. So on that note, I'm going to go to this chart on the bottom right here, the flows into early delinquency. So these are different types of debts, and then how many people are defaulting or going into delinquency, or their late 30 days on their loan payments. So student loans have been waived basically for the last 2 years. So I'm actually kind of surprised, or last 4 years, I believe, but so kind of surprised that number's not zero. But I certainly expect the student loan payments to revert back to earlier levels at some point when we start making people pay back loans, unless there's some dramatic thing that happens there. So this one is probably one that's most likely to change the fastest in the short run. But overall, like if you look at where we are compared to 2007, 2009, we're not in a terrible spot. Like we're not as good as pre-COVID necessarily, but from a debt delinquency perspective, things are trending up and plateauing a little bit. So this is absolutely some area that we're watching for an economic indicator, so to speak. And then again, just the chart on the top is just showing your collective income versus debt payments. So as a whole society, 11% of our income is going to debt payments, which is much, much less than even 2007. So I think part of the reason for this is there's less people just buying homes right now. There's more people in the renting cycle than home buying. And so that makes this number look a little bit better than all. So, okay. And it looks like we got some questions answered there. So thank you, Bob.
I'll hold some of them for the end too, Nick, that I just think will make sense to kind of tie everything together.
Okay, cool. So real GDP growth, economically speaking, it's like, how's our country as a whole growing? And we want to see this number, just be a positive number is the most important thing. When there's 2 consecutive quarters of negative growth is when we call that a recession. So Q4 up in this 3% range. Everyone is expecting the US to only be in this 2% range, but we've been honestly crushing expectations on our growth as a country in the 3% area. And to the extent that normalizes down to 2%, we'll see. AI and a lot of other productivity gains are kind of changing people's forecasts on this. And again, the unemployment rate, we're expecting that to maybe tick higher into 2025, but overall, it's still right in that sweet spot where it's given the Fed, who cares about the unemployment rate probably the most, enough reason to lower interest rates, but not spiked up so much that we are clearly in a major recession. So, okay. All right. And then inflation to all of our clients who have bought anything in the last year. You've experienced that was much higher than it was 2 or 3 or 4 years ago. So again, the inflation rate is coming down, but that does not mean the cost of things is going down, right? It just means the rate of increase is slowing. And so for things to go down in price, we would need something called deflation. And I don't think that's anyone's objective necessarily. We think, like, in our minds, like, man, I really wish that car only cost $20,000 instead of $40,000, just for example. But deflation has a lot of bad side effects too. So in our minds, like, you might want prices to come back down to where they were, but it's that can be a treacherous, slippery slope as well. So all right. And I'm going to actually pause or skip that next part here. So no, I'm flying along, and I've shown this chart to many of you before who've sat through a charts presentation with me before, but this is showing the path of the Fed controlling interest rates over the last 20, 30 years or so. And even though they're trending down, they plateaued and started to trend down now. You know, their long-term goal with this interest rate, and this is the short-term rate that applies to savings accounts and all of that, but their long-run goal is to get it to 3% now. And you can see there's actually a really big dispersion in the market's expectations, which is why bonds have taken a beating versus what the Fed is saying their path will be for interest rates. So we'll see how this shakes out and the extent that they quickly or slowly get to this. I know today Trump was doing interview and said that he's going to pressure the Fed to lower interest rates faster. So the Fed's supposed to be an independent agency. I don't know how much he will cave to that political pressure or not, but this is a big area of concern that impacts a lot of things, specifically debt payments and also savings. So, all right, I'm going to skip over a couple of these in the interest of time. So thank you all for hanging on me for 30 minutes here. So bond market, it's been a really weird year. So let's start with this chart on the right, the yellow line, where when we were a year ago, the 3-month T-bill or 3-month savings instrument was 4.75%. And today, the Fed has lowered rates quite a bit, and now it's 4.3%. And almost every time historically, when the Fed does this, this is the part that they control. When they do this, the whole yield curve generally shifts down with it. Now, in 2024 and currently so far this year in 25, that has not been the case. You can see the long part of the curve, or the longer duration part of the curve, is actually ticked higher, and just like graphically showing on the left, like how much of an anomaly that is. Like, it's actually never happened before where interest rates on the long side have kicked higher compared to what after the Fed has started cutting rates. So in summary, stocks, large cap growth were the name of the game, and investors piled into the AI names like NVIDIA, making it the most valuable company in the world. Core bonds were positive 5% through all the way through mid-September. We thought it was going to be a shining year for bonds to be, 6-7% return, but that didn't prove to be the case so far. And economically speaking, overall, it was much, much better than people expected, which actually gave the Fed room to slow the roll on interest rate cuts, which ultimately led to everything that we're seeing today. So I'm going to pause here on just a sec. I want to make sure I get to these questions and be respectful of everyone's time here. But is there a question you want to touch on right now, Bob, or should I keep going here?
I would say just go ahead and keep going. Again, we'll get through the presentation and then I'll follow up. There's a question about AI and a question about, again, the geopolitical environment and, kind of how we're gauging that. Bruce said you did a good job of answering it, but we'll revisit it to just, get some insights at the end.
Okay, great.
Yep.
So 2025, we expect the economy to still be very, very strong. And Bill Ackman, he's, a famous billionaire investor, Pershing Square Capital, and he certainly doesn't always get it right. But his quote on CNBC was, we're stepping into the most pro-growth, pro-business administration in my adult lifetime. And he has more gray hairs than me, so that means more when he says that. But it's still true, and we all believe that we're here at Balance. So, and also, again, just going back to that conference board indicator of optimism, the first one we're talking about, the small businesses, this is just people as a whole. Respondents expecting stock prices to rise over the coming year. Since they started doing this 30 years ago, it has never been so high, by far. People are feeling optimistic about stocks, which is also part of the reason bonds haven't been so favorable either. People are just overweighting stocks more and more. So, more granularly into our views on stocks, this is looking at the last 15 years or so in the US versus the rest of the world. And again, this chart is pretty compelling in a lot of ways. But again, we have the earnings to back it up here. The cash flows and the profits are coming from the US, but also all the innovators and everything else. Like we're like the NBA of investing. People send their best players to come here to start companies to grow. And honestly, like when we talk about US, most of the companies in the US have most of the big publicly traded stocks like this have huge portions of their revenues from coming overseas anyway. So it's actually true that 40% of revenue or profits in the S&P are coming from sales done overseas. So the U.S. stocks today are not just U.S. stocks. They're actually global stocks. You can like Microsoft, Tesla does 40% of its sales from China, and so there's huge diversification or revenue diversification at least coming through in just the U.S. portfolio. So we haven't completely abandoned the rest of the world by any means, but we are currently overweight, and we believe we'll continue to be overweight U.S. All right. And then what do we think is going to happen with bonds? So I think this chart, nice color coded. What do we think is going to happen? So with bonds, it's actually really easy for the most part to tell you what do we think is going to happen with bonds, because pretty intuitively, if you loan someone money for 5 years at 5%, for example, over that 5-year period that you're going to be paying that 5% a year. So if we look at bonds, and this is again like core bonds at the beginning of the year, they had a yield to maturity or YTM of about 5%. So we can safely say that mathematically, the way the bonds are priced and structured today, we're looking at a 5% annual yield, annualized return for the next 5 years or so. So again, not necessarily double digits, and that might be a year where there is double digits right in the beginning, and then it levels off to 3%, and then so on and so forth. It might not be exactly 5% per year, but this is what we're thinking for fixed income, and it's proven to be 88% of the time that has historically held true, that relationship. So looking ahead, we prefer US versus international. We prefer large versus small companies. And we continue to think that AI will absolutely reshape the economy like it already has. And it's really taken hold. Like first monies have gone into the tech sector, but we do believe that AI will impact the productivity of all areas and industries of the economy. It's a huge boom, transformative time, really exciting time to be investing in the world. And a lot of it I don't think has come to fruition yet as far as the productivity gains. And so we'll see more and more of that like be applied to our real lives, I think, in 25 and 26. And hopefully all that will trickle into that very lagged economic data sooner than later. Core bonds
Hey,
again.
Nick, if I can interrupt quickly, one of the questions was about AI. So since you were on it here, I will bring that up. So Jeff asked this. He said, given the amount of investment in AI already and projected over the next few years, how do you view this segment as an opportunity for investment within a portfolio and AI as a tool for investment decision making? So sort of a two-pronged question, both, I guess, as an investment and then a tool for decision making.
Yes. So the beautiful thing is, Jeff, I can confidently say that we are using both, right? So even just owning the S&P 500, like there's not a single company in there that is not using AI within itself currently to try to improve those profit margins, to try to be more profitable, more productive. We've seen like Google already reduce their work count by 10%, and a lot of the big companies are, paring down to be more efficient, like body wise, but also be more or forcing themselves to leverage AI more in their productivity. As far as the way that AI gets applied to the way that we invest, that's a really great question, and I've been asked it a couple of times. So we have a few strategies available that do exactly that, where it's AI helping to do like portfolio management, decision making, but also like BlackRock is one example of a company that has been using big data for a very long time. And to the extent where they have satellites of their own, like currently up in the sky, and they look at things like shipping patterns or how many cars are in the Home Depot parking lots across the country in any given quarter to try to better project what Home Depot sales are going to be for that quarter. So when you already have a company like that that is capturing all that data and then is able to use AI to help with decision making, like that's huge. But also just like the way that the Fed, it talks about what their next move in interest rates is probably the greatest example of AI being used investment purposes. So every single word gets analyzed and like through an AI model, and you can tell the differences of, oh, instead of like this month, they said this word instead of this word here. And it's like this very structured format. And so AI is number crunching every time they do the interest rate updates, and also like when companies do their quarterly reviews of profit expectations and all that, AI is just number crunching every single word they say and trying to get a better estimate there. So that's what's happening already. And to the extent that we do have access to those things, BlackRock is one of the biggest players in space as far as using AI to help guide, different sectors and areas that they lean into. So core bonds, again, 5%, not a bad expectation for the next 5 years. I know like financial planning wise, we're aiming for a little bit over 5% in most cases, maybe like 6-7%. So if we're already getting 5% on bonds, that means we don't need a whole lot of risk elsewhere outside the portfolio. But securitized debt and private credit, I know I've talked to some of y'all about that already, but those are areas where, the return profile is almost double what the ag is doing. So those are areas that we do expect to trickle into more of y'all's accounts in 25. Many of you already have some exposure to that. And then economically speaking, with Elon trying to cut $1 trillion of government spending out of the economy, that is absolutely going to be disruptive and very turbulent in short term. But again, economic data is very lagged. Those tariffs are supposed to come in for the first time in February 1st, so in a couple of weeks, but we won't even know the magnitude of that for months until after the fact. And to the extent the federal government, which is the largest employer in the country, if we're pruning people out of that and removing the amount of workers there, then that could absolutely lead to a spike in the unemployment rate that we were talking about. That is already near the questionable area. So, and again, AI just being applied to the real world, I already talked about. So, all right, I'm gonna pause there. I had a couple questions come in about Trump specifically, even before this call, like what's happening with Trump in the economy? Like what is the short-term thing? And so just like visually, if we look at what's our spending or our outflows versus our inflows, Trump's looking at increasing tariffs over here in this spot highlighted on the left, decreasing these other areas in some ways, like he's already mentioned lowering corporate taxes. But then also simultaneously cutting other spending, but also just cutting spending out of every single one of these. So right now we're creating a deficit. So every year we're adding $2 trillion onto the debt. And so in order to fix that, we need to have a surplus. Like we need to have more money coming in than we're spending. And just like visually, what are the proposed tariffs? And this is a very fluid thing that changes day to day and tweet to tweet. But this is kind of the expectation, like graphically, if we look at even his first administration, like, oh yeah, the tariffs went up from 2018 to 2019. That is like, we're talking, what he's talking about now is dramatically different than what he did in his first administration, at least what he's bluffing or proposing. And so we'll see how much this actually comes to fruition. But that is what is being proposed. And so graphically, what does US debt look like? Increasing at an exponential rate. And then the number of pages in federal tax rules, great measure of bureaucracy, also increasing at an exponential rate. So what he's proposed, or the only person we have to look at who's actually successfully done what Trump is talking about, is Javier Milei from Argentina, prime minister there. And over the last year while he's been prime minister, that we thought our 9% inflation was bad. And don't get me wrong, it was really bad. But like Argentina had 25% inflation for multi-months. And he, over the course of 1 year, was able to get inflation down even lower than it is in the US. And how he did that, his rallying cry is taking a chainsaw to the government and just cutting out every piece that he can. So not a very delicate approach. I think Trump will be more delicate because we have a bigger, more complex thing, but maybe not. But also the case for investing internationally, the Argentina stock market over the last 24 months, like we were all happy with our 25% gain in the US. Argentina's stock market up 172%. Like that's not a single stock. That's the whole stock market up that much. So when people ask me like, what does deregulation and like I said too, he was able to get a budget surplus for the first time in 14 years. If the US is able to do that, like, man, Argentina really found a way to win and have all of their citizens win too, who are invested in these things. So that's a wrap.
All right. Well, awesome, Nick. Thank you. I love that chart, the exponential growth of the tax pages. It's just something that it just made me laugh looking at that, but that was really interesting. But I think I'll re-tee up because just kind of finishing up with the new administration here. And Bruce asked a question about what are your main sources for gauging the geopolitical environment to determine if investment strategies need altered. Can you just touch a little bit maybe on what resources we use, but then also maybe our view of the how we let politics impact some of our investment decision making as well?
Yeah, absolutely. So I think the biggest thing in the short term is Trump's really pushing to get people to shift their manufacturing to the US to avoid these tariffs. And even if he's successful with that, that's not something that's going to like immediately happen tomorrow. You know what I mean? So the resources we use to look at this stuff, again, probably our biggest research provider that we rely on is BlackRock, but we also use JP Morgan. As you saw their logo on most of these graphs, they give a lot of really great insights. But honestly, just looking at investing through that lens of, okay, if we are trying to shift manufacturing or shifting the headquarters to the United States, again, we are already overweight US domiciled companies, even though they are globally diversified themselves. And so navigating that's kind of the big hurdle too, is like how much to have overseas versus not overseas. And yeah, the being overweight US has certainly paid off. And we think it will continue to pay off here especially in the next 6 to 12 months as we look at things.
Great. Thanks, Nick. And I will let's see if anybody else has any other questions, and please feel free to ask away while we have Nick here. The other thing I'll say is maybe folks are, thinking up questions or just kind of wrapping up here. We not only are recording this so that you can, kind of go through it again if you so wish, or send it to a friend or family member or whomever, but also if you'd like the slides, if you'd like any of these charts or any of the many interesting things that Nick has put together and put in here, we can also send out the slides as well for you to review. So just let any of us know if that's something that you're interested in, and we'll also be sending out this recording tomorrow just to follow up on this call as well. Okay.
Cool.
Do you see that question up there, Nick?
Yes. All right. So question from Jim. Energy, is there consideration on those engineering and utility firms that are looking at small modular nuclear reactors, otherwise known as SMRs? See, we have acronyms for everything, which are safer and more efficient and upcoming tech for sure. So I've read a lot about SMRs, and I've actually had other clients who are really interested in trying to invest in those. It's really tricky because just nuclear energy as a whole kind of has a bad stigma on it. And it's also kind of like, I don't know, a little hypocritical for us to say like, okay, we're going to develop 1 million of these SMRs, and then all of the other countries, or even like competing countries to us like China or North Korea, we're like, oh no, you guys are not allowed to create more nuclear reactors, but we are. And so it's part of, that's also like a huge part of the negotiating, like why there is or is not like political pushing for these things. I think that they're awesome. Like I would love to have a little power station, a small nuclear reactor outside the house that doesn't make my kid grow a third arm, but like powers the whole house for 20 or 30 years. Like that would be incredible technology. And so yeah, short answer is I know some very small stocks that do that. Most of them have, almost no profits so far. But, to the extent that you're interested in that, we can talk about how to layer in a slice of something that you're interested in.
Yeah. Well, Nick, I like that answer. And Jim, I love the question. That is something that, just as an aside from a non-investment perspective and just as a nerd in general for me, just looking at new forms of energy production going forward, because it's going to be such an important thing as our economy grows, as our world grows, as our energy needs continue to increase. It's not that oil is going away or anything like that. It's just we need to have these different options as far as energy production is concerned. And that ties from everything to just powering your home, to desalination, to all kinds of other solutions. And this ties back, I think, Jim, and just everybody, if you read some of, the emails that we've sent out over the, past few months, one of the things I and we always like to lean towards is just the ingenuity of people to solve extremely complex problems in new and incredibly intuitive ways. And one of those is like small modular reactors, right? If we can refine that technology, that's not only going to be a great investment potentially, but it's also going to be such a great thing for the world and the economy as a whole that it's almost even hard to put a price tag on it. So I think it's a very interesting question. I think it's a little bit more difficult to know exactly how we invest in it, but I think the results of it is a net positive for the economy, for our portfolios, for us as investors, and quite honestly, for us as humans in general, because the more power everybody has, the more access to information and data and lights and water and all that, that more people can thrive, and more people can be a part of the economy. And it's just a great potential there. Okay. So, trim. All right.
But share my screen. How about that? There.
Oh, yeah, that works. Well, and that would have been fine to have that up there for making sure we get questions. So,
Yeah.
Brad asks, are water stocks interesting, Nick? And Brad, as you're thinking about that, I'll let you think about it for a second. He also asked if we had a chart for 2025 so far, just out of curiosity, with just how the market has gone for the first, 23 days or, whatever. If you have something like that, you could pull up quickly that we can pull that up for.
Jeez, I don't have the hospital chart. I don't have. Come on, Brad, man. So water stocks, kind of think of that as like a couple ways, like, I don't know, like utility companies as a whole. That's honestly like everything I'm reading is like, if there's one sector that's going to get disrupted by AI, it's going to be utilities. And I think that that's something that can be interesting. I don't think that we'll ever like get so granular to make a bet like in our strategies to overweight like water stocks, so to speak. But there are a lot of interesting things there in general. Like it just more falls into that utility category and municipal bonds, which even those have been really kind of under fire. I don't know if you guys saw version 1 of this next political regime's proposal, but it's talking about changing the taxation of muni bonds. It was talking about changing the taxation of muni bonds to not be exempt in some ways. And so that could really actually hurt municipalities locally and that kind of thing. So none of that stuff is like actually into fruition yet. But speaking of those specifically, that's like an immediate headwind that I read about yesterday with their proposed rollout. So yeah. And for year-to-date stock market performance, we are,
I feel like we need a drum roll button or something to, make a little sound effect there.
We are up 4% year-to-date in U.S. stocks. So, through the month of January. So if we can just do 4% per month, we'll be up 50% by the end of the year. And we can all retire happily and go from there. So
great. All right. Well, that puts us right at 8:30 between questions. Me butting in and giving my opinion. So thanks for being patient with me there, Nick. Nick, thank you so much for the presentation, for the review, for the insights, and just reiterate for everyone. First of all, if you want to watch this or want any of the slides, just let us know. We'll get that out to you. Second of all, you can always feel free to reach out to any of us, whether it's Nick or me or Tyler, Tim, Ryan, Lori, any member of our team, to ask more specific questions or dive into how this impacts you or any changes we may want to make. But again, it all ties back to the plan, to your goals, to the specifics for you and for all of the individuals that we are able to serve here. And we appreciate your time tonight. We look forward to a very successful and happy 2025 for everyone. And please let us know if there's anything else we can do. And Jim asked, where's the Ohio State banner? It's in the other room. It's way too big to fit in this room, Jim. Buckeyes fans, for those of you that are in here, all very thrilled with what happened on Monday. If you're a Notre Dame fan, a Texas fan, or Oregon fan, or anybody we kind of ran through, apologies, but go Bucks.
man, oh man.
Yep. All right. Well, thank you so much, everybody. Thank you for the great questions. We appreciate the time. Nick, again, thank you so much for the presentation, for talking at us here for a good 30 minute, or excuse me, a good hour. And we look forward to doing this. And we will have more of these coming up. I think in February, we're going to do a long-term care webinar. In March, we're going to do an IT security and just making sure you're protecting your money and your assets from scams, IT issues, all kinds of things like that. And if you have any other topics that anyone would find interesting, let us know. We'd love to do these webinars and keep it going. So thanks for being here tonight, and we'll talk with you all again soon.